Hey there, welcome to another episode of Harmonious Wealth. I'm your host, Iyanna Vaughn, and today we're going to be talking about why you must not create random revenue goals. So let's be honest. Do you actually know how much revenue your business needs to make to pay yourself comfortably? Or are you setting random six figure or even seven figure goals without a clear plan behind them? If your business is making between 250,000 and a million a year, but your cash flow still feels unpredictable, then your revenue goal might not be aligned with where you actually are and when you need to scale as you scale. Let's fix this today. I'm going to be breaking down in this episode why your revenue goal should be at least twice as much as your CEO salary. We talked about CEO salary in the past couple of episodes. I'm going to also share why you must price your services or your offerings based off of profit and sustainability, not just revenue. And I'll also be sharing how to understand your conversion rates because that's the missing key to hitting your revenue goals consistently. Because you don't need more money, you need the right money in the right way. Okay? So your revenue goal must be at least twice as much as your CEO salary. So here's the problem. A lot of times I see people have random revenue goals because they sound good, because they look to the left, they look to the right, and they make the assumption that, okay, everyone else has a specific revenue goal. Why not I make it? But the revenue goal most of the time does not factor in your taxes, your expenses, and then your investments for growth, right? And you might be thinking hitting multi six and seven figures and your business automatically means success. But if you are paying yourself 8,000 a month as your CEO salary, that doesn't factor in like your payroll taxes. It might not factor in like your 401k contributions on the business side. It might not factor in the HSA contributions or the insurance, right? So you need a holistic approach of like your total CEO salary and compensation and then doubling that at least doubling it so that you can create your revenue goal. Right. So again, if you're paying yourself 8,000, 16,000 might not be enough. You might need more, but at least you need to really understand where you are. Right. So here's the thing. Your business is not in startup mode once you hit $250,000. You're actually beginning the steps of scaling. So scaling to me is when you're able to create a service or an offer that you're not the only one executing on it, right? Your systems, your team is able to execute that on your behalf, right? So then that way you're able to duplicate your intellectual property, you're able to duplicate and replicate your curriculum or your service or your expertise, so then that way your business can sustain itself without you being the only one to execute. So when you're able to create a revenue goal that's at least two times your salary, right, you're able to account for seasonal dips because there's always seasons when you will see a dip in your revenue. You're able to also assume and adjust for team costs, right? And then you're also able to appropriately maintain profit margins throughout the year, even when you have those revenue dips. And it's not going to sting because you intentionally created times where the seasons of uptick made up for those seasons of a downturn. Okay. So say for instance, if you're wanting to pay yourself or your full compensation plan is 150,000 and your revenue goal is at least 300,000, right? Then you're able to say, okay, I at least have a first number of what my revenue goal should be based off of my CEO salary. So to tie that back, right, when we initially stop treating our CEO salary as an afterthought, we're able to then hit or create a revenue goal and stand by her. Stand by her. So then that way we're not trying to figure out how to pay ourselves because of a random revenue goal. The next thing is we need to price our services for profit, not just revenue. Okay, not just revenue. So, have you ever looked at what other business owners are charging and you're basing your pricing based off of that? I probably said that in a very elementary way, but let me say it in a more sophisticated way. So, have you ever looked at someone's website who has a similar service to you and try to compare pricing to say, okay, what is someone going to pay for? You know? We got to stop doing that. So here's where I see business owners getting stuck. They are not pricing for profit. Instead, they might be pricing based on what others are charging. They might be experiencing, even at 250,000 plus a year, imposter syndrome, and they're not valuing their service or offer like they need to based off of the expertise that they have. And then they also don't build in like profit margins based off of their price of their service or their offer. One thing that I find is project based service providers have a tough time pricing their service. So, what we do with our clients, we factor in the costs before we even pitch pricing to clients. So, say I know I talked about in a direct cost episode or an expense episode that, you know, your admin team or like your team should be about 20% of your revenue total. However, one of the biggest challenges that I've seen is when project based business owners don't price for profit. I know I talked about in a previous episode that your total team should be about 20 to 30% of your revenue. That way, you have adequate amounts of profit left over for your operating expenses and then finally your CEO salary. However, with project based business owners, the team percent might be a little bit more, but really understanding what that percent is and then adjusting it based off of your total expenses is going to be imperative to ensure that you're still pricing for profit. Okay. Not only are you pricing for profit overall for your business, but you need to price your projects for profit as well. Projects can be like a conference, right? Are you pricing your conference for profit, or is your conference profitable? This is when it's going to be important to have your income statement have different tiers or different class tracking based off of the project that you have. So, another example is when I service project based business owners, we look at each individual project to ensure that it aligns with profitability, the ideal profit margin. And then after looking or analyzing the profitability of each project, we're able to then say, okay, going into another iteration of this type of project, do we need to adjust pricing? So then that way you can see an overall increase in profit margin, or do we need to make some adjustments in the costs? So that is an advanced tactic that I use with my clients. So if you ever come to a point where you might have one-on-one consultations, you might have one-on-one services, or you might have a team where you do projects, but you're really trying to understand what is profitable, even down to the project level, you might need at this point a financial strategist or even a fractional CFO to really help you understand what these numbers mean, broken down by a specific class or a specific category. Especially if you have a conference, because I know, conferences are extremely expensive. However, you need to understand the return on that conference based off of all of your expenses, the sales, and then when you sell on a stage, what are you making back from that conference? So then that way you can look at not only the overall profit, but the profit based off of the class. Let me know if that makes sense. So, all in all, pricing is really not just about making money. It's about making money that works for you and keeping money so then you can overall pay yourself that CEO salary. The CEO salary is a cornerstone of your financial strategy. The next thing when it comes to creating revenue that's attainable is understanding your conversion rates. So your business might not just need more revenue, right? You might need more predictability. So there are months where your revenue is amazing, and then there's months where you might be scrambling. So instead of, hoping people enroll in your program or your offer or convert for your service, you need a tracking system so that you can know based off of however many people sign up as a lead or however many people that you talk to as a prospect in a sales call, how much you can convert each and every month, even a seasonality. So, say, for example, to create predictable income as a service provider or even as a coach, I would track not only my conversion rates overall for the year on average, I would also track my conversion rates in different quarters and in different seasons. So then, if I was to track it for the last few years and my conversion rate is typically at 80%, but in the summer, because it's slower, even though I have sales calls, my conversion rates might drop down to 70%. But you need to know it in advance so then that way you're able to create more predictability. Most entrepreneurs don't hit their revenue goals simply because they don't have enough leads in their pipeline. So you might be stressing out about not making enough money, but maybe it's time to ask, are you getting enough leads? And even if you're getting enough leads, maybe your retention rate isn't where it needs to be. Are you retaining your clients? Are you providing a great customer experience where they're re-signing for the next time, or you're retaining them for the whole year? Those are things that we want to look at versus just revenue or you bring people in. So, overall, we talked in this episode why we need to stop guessing and start strategizing. So, for this episode, I want you to remember one, your revenue should be at least double your CEO salary because we're going beyond a startup. We're thinking of scalability. The second thing is your pricing needs to support your profit, not just your revenue. Because if it does not, it'll always feel like you're underpaid. And the third thing is your conversion rates will determine your actual revenue consistency, and you need to track them. Okay, quick question. Do you know how many leads you need each month to hit your revenue goal? It's time to start guessing and time to start strategizing. Let me know if this video was helpful for you. Please like, share, and subscribe. And I'll see you next time on the next episode of Harmonious Wealth. Bye.